Good evening, everyone. Welcome you all to today's session, Tax Planning for Doctors. Before we begin, I would like to tell you that we are coming up with a series of webinars exclusively for doctors. If you have missed any of our previous sessions, request you to go to our YouTube channel, Right Horizons, to view all the videos there. And I would like to also give a small disclaimer that today's session is only for knowledge sharing and educative purpose. For any tax-related queries or decisions, you should always consult your tax expert or your chartered accountant. Right, so let's begin. So today's agenda is identifying what are the multiple sources of incomes specifically for doctors, and how can we identify the expenses related to these incomes which can be taken as a deduction to reduce the tax liability. And what is presumptive taxation and what are the benefits of the same, and who can avail presumptive taxation? And what are your tax saving options? We will have a look at that, brief look, and lastly, we'll end it up with a Q&A session. In between the session, if you have any questions, please drop it in the chat box. Now, before we begin the session, we should first understand from an Income Tax Act perspective, who should file an income tax return, right? Any person who is earning a total income in a financial year of more than 2.5 lakhs is required to file income tax returns. Now, what is total income? So when we are assessing the incomes for tax purpose, we include all the incomes, which is salary income, rental income, your professional income, dividend income, interest income. All of this will come to be computed as your total income, on which you will have to deduct the expenses or applicable deductions, and then your tax saving investments, and then arrives the taxable income on which you are required to pay tax. So that's about it. So now, before we begin, any taxpayer should understand what are the 5 heads of incomes as per the Income Tax Act. The first one is income from salary, income from house property, profits and gains from business or profession, capital gains, income from other sources. Now, salary income is straightforward. If you are employed as a doctor with a corporate hospital, public or private, that becomes your salary income. Income from house property is your rental income. If you have 1 or 2 properties from which you're getting rental income, so that becomes income from house property. Profits and gains from business or profession. Medical is a profession. So if you're running a business or a clinic, and if you are getting incomes from there, that is treated as profit and gains from your profession, which comes under this head. Capital gains are your gains from selling a property or selling your shares or equity mutual funds, debt mutual funds, or any capital asset. So that is your capital gains. So on these gains, you will have to pay tax. So any other income apart from these heads comes under the other sources. So what are the income sources for doctors? So broadly categorizing, these are the common sources, where a doctor can earn income, because most of the doctors are, engaged in multiple activities for earning income. So one can be your income from your practice or business. If you have a clinic or a nursing home where you are running your own practice, you have a business setup, so that is your income from practice or business. If you are employed with a corporate hospital, that is your, as a salaried person, that is your salary income. Now you should understand that you can also get salary as a consultant, right? So when it is a consultant salary, you will observe that there is a 10% TDS on your tax deducted at source on your payslip. So then that is a consultant income, which is different, which comes from income from your practice, income from your profession, actually, right? Then you may also be earning some income from speaking at different seminars, events, conferences, or something like that. So that is also an income for the doctors. Some doctors are also lecturing in some institutes, medical institutes and colleges. So that is another source of income. Over your earning years, you would have invested in properties for rental income purposes. So if you are getting rental income, so that becomes your income from house property. And there are some other earnings like you would have kept some money in your FDs, savings accounts. You might have invested in some dividend-paying shares, so they pay you dividend from time to time. So these are broadly your income sources. So it is important as doctors when you're filing your returns to identify and collate all the information about all the incomes that come to be computed as your total income. So moving on step by step, I'm trying to set the context here. So what is the Rule 6F of the Income Tax Act? So this rule talks about maintaining books of accounts. Who are required to maintain books of account as per the Income Tax Act? For this purpose, income tax authorities categorizes specified professionals. Specified professionals, there's a list of professionals under which lawyers, engineers, architects, medical professionals, doctors, all of you come under specified professionals. And as per this rule, if your total income exceeds 1.5 lakhs in the last 3 years, right? So you are required to maintain your books of accounts. What kind of books of accounts you're required to maintain? One is your cash book. In the cash book, your day-to-day cash receipts and cash payments are recorded on a day-to-day basis. So if you have a clinic and if you're making a payment to somebody which is related to your business by cash, so that should be recorded in the cash book. If you're receiving a payment by cash, that should also go into the cash book. Next comes the journal entries. So here transactions, everyday transactions are recorded into debit and credit. So for this, you'll have to hire a professional accountant, but just that you should know what is a requirement as per the Income Tax Act. So journal entries then go on to build the ledger books. So it is just transferring the journal entries into proper categories into the ledger. Okay, if you're charging somebody or paying somebody more than 25 rupees, you can have photocopies of those bills and invoices or receipts. If the payment is more than 50 rupees, okay, you should maintain the original receipts of all these expenses or receipts, whatever it is. So most of the times it's online transactions these days. So we'll come to that, how those can be taken into consideration. And as a medical professional, you're required to maintain two more additional records for your clinic or nursing home or a small hospital you could have. So there you are required to maintain the daily registers with the details of all the patients that are visiting you, what kind of treatment you have given them, what fees were received, what are the date and all that. Alongside, you should also maintain an inventory register of all the medicines and consumable items on a daily basis. So as per Rule 6F, this is like, this talks about maintaining of record. Who needs to maintain books of accounts. Now, maintaining books of accounts for record purpose is one thing. Getting it audited or not for tax purpose is another thing. We will move to the next section, which will clarify, whether to get it audited or not for tax purpose. So when it comes to income from your practice or business, you can consider it into two categories for tax filing purpose. Either you can consider the income as purely business income, where you want to maintain the books of accounts and calculate what is the profit out of the business, and then pay tax on it. That comes under PGBP, that is profits and gains from business and profession. Another thing you can also opt is your presumptive taxation. Now, first, let's talk about presumptive taxation. If your annual total income, I'm talking about total income, all the incomes put together, if it does not exceed 50 lakhs per year, then you can easily opt for presumptive taxation. Now, what happens in this taxation is your income is presumed. That means you can straightforward declare that you have out of your annual total turnover, 50% is your profit, and on that profit, straight away you're going to pay tax. So this comes under Section 44 ADA. Here, you don't have to get your accounting records audited. You can maintain them for your reference and for a disciplined approach, but audit as such is not required for tax filing purpose. Then comes considering as a business income. Here you have to maintain proper books of accounts. Everything needs to be recorded as per the Income Tax Act requirements. You have to calculate profits and losses after deducting all the Business related expenses, allowable expenses, I will show you, which can be considered as allowable expenses. P&L and balance sheet is a must, and audit requirement is mandatory if you are considering as a business income. So in short, if your income is less than 50 lakhs, it's always good to go for presumptive taxation. If the annual income, total income is more than 50 lakhs, obviously it will come under business income, then you cannot file under presumptive taxation. Also, if you opt for presumptive taxation, it is said that it will continue for a period of 5 years. You cannot change in between. If you change in between, then that form of tax filing again continues for next 5 years. So you have to carefully choose, consult, look what best applies, best works out to you. So then take a decision from there. So, what are the expenses that are allowed as deduction if it is if you're looking at declaring as a business income? So, all the expenses directly related to the running of the clinic or running of the nursing home, which are directly related to you performing your services, that can be taken as a deduction. Simple first one is salary to all your employees, your office boys, the receptionists, the nurses, cleaners, sweepers, anybody. So whatever you're paying them as salary, incentives, bonus, everything can be taken as a deduction because that is clearly an expense which goes out of your receipts. Then comes digital marketing fees. Suppose you are you want to scale up and you are using some digital marketing services and you're paying fees for the same. That also you can take as a deduction. If you're hiring a blog writer or a content writer, if you have a website and you're using their services and you're paying fees, so that also can be taken as a deduction. A lot of doctors use portals like Practo, where they get themselves registered to get a better visibility and promoting their specializations and things like that. So there also, when you register on that website, you pay certain fees. So that also can be taken as a deduction. Premium for professional indemnity insurance. Now, professional indemnity insurance is very much required or very important in the case of medical profession. So, and it comes at a considerable, decent, reasonable cost. So that also you can take as a deduction. Interest on borrowed capital. Now, if you've taken a loan to set up your practice, for example, if you have taken a loan to buy some equipment or to build the building or to make some interior changes required, you would have rented it out and spent some money to even make the changes that are required. So any loan that you have taken for the purpose of setting up your practice and business, that also can be the interest paid on that loan can be taken as a deduction. If you have rented the premises, if you're those rents, anything that you're spending on the buildings for repairs, annual repairs, maintenance, all those costs can be taken as a deduction. Repairs and insurance of equipments, machinery, furnitures, anything can be included, which are directly related to running of your practice and business, right? Depreciation is one. So building and car if you're using for your practice purpose, it could be a small ambulance, if you have kept an ambulance. So all those are depreciating assets, right? So you can go for claiming deduction for depreciation as well. Here you get two methods of depreciation. One is a straight line method and one is a written down value method. So you need to work with your tax expert to see which one suits best for your type of assets that you're considering. And there will be a certain percentage, allowable percentage of depreciation every year. So you can claim that as an expense. Fees for professional services or fees for technical services payable. For example, if for example, there's a equipment or a machinery or some X-ray machine or something has gone bad, and you have called a technician to repair that, or you have AMC charges that you pay every year for any equipment. So all those can be claimed as a expense for your business. So what happens is, out of your business income from business, these expenses get deducted, and after this, your net income is arrived. From there, again, you can have some deductions of your tax saving investments that you have made, that is ATC, ATDD, donations, and we have, a lot of things. So all those deductions can be taken, and after that comes the taxable income, where you have on which you are required to pay tax. So now I think it's clear, like, how do we go for a business, declaring a business income or a presumptive income? We will look at presumptive taxation and how it is beneficial with a small example. Pratham is a doctor and he has his own practice. He also works as a consultant in many reputed hospitals. He has tied up. Okay, he earns an income of about, sorry for the typo here, it's 45 lakhs. His total income, that is from consultancy and his own practice, is coming to 45 lakhs in a year. So his, if he goes for goes for a business, declaring as a business income, then what he's going to do is going to deduct all the expenses, related expenses, and these are his related expenses: work related, travel, transport, meeting, conference, everything. All this put together is coming to 15 lakhs. So 45 lakhs minus expenses 15 lakhs will give us 30 lakhs, which is the total taxable income now. These are the, let's assume that these are only his two sources of income, and out of this 30 lakhs after deducting expense, these are his taxable income. So now on this 30 lakhs, he needs to pay tax. So if we apply the tax slab rates and calculate the income tax that he would be paying, it will come to about 7,12,500. Now the same way, if he opts for a presumptive taxation, so there what happens, straight away he is going to presume that his taxable income after availing 50% as expenses comes to 22.5 lakhs. So straight away it's a 50% income. So there, if we apply the income tax slab rates, his tax liability comes to 4.87 lakhs. So totally he will be saving 2.25 lakhs if he opts for presumptive taxation. So those are the benefits of presumptive taxation. So if your incomes are less than 50 lakhs, it makes sense to go for presumptive taxation, because it is very, very easy to file. No need to get your records audited, account books of accounts audited. So there you are saving the fees of your tax expert and consultant, auditor, and accountant as well. So no need to pay advance tax in installment. That is one more advantage. So all at once you can file on 15th of March once in a year. So that will suffice. So those are the benefits you can consider for opting for presumptive taxation. Now let us look at what are the tax deductions allowed under for the different heads of incomes. We saw the 5 heads of incomes, right? So we'll go one by one. So against salary, what are the deductions available? Straight away, there's a standard deduction of 50,000. Apart from this, if you are a government doctor, employed with a government hospital as a doctor, you also get to deduct entertainment allowance, where it is the maximum of 5,000 rupees. And then employment tax is also deductible, directly deductible. Now, if you are working as a consultant with any hospital, you will be given Form 16A. And what does this form say is, it's a certificate of the taxes that are deducted at source. So when they are paying you salary as a consultant, the employer is supposed to deduct tax at source, about 10%. So they will deduct that and then your salary is paid. So in Form 16, all these are recorded. What are the deductions at the employer level? So you have to ask, if you're employed as a consultant, you have to ask for Form 16A to understand what has been deducted, and then over and above that, what is required to be filed. If you're a corporate full-time employee of any hospital, then you have to ask for Form 16. And this is also the same thing. Any tax deducted at source, it will have a record of the same. So this will help you understand how much you have paid and how much you need to again file, the balance of it. Income against house property. So here, straightforward, you would have paid, now here we are talking about rental incomes. If you are getting rental income from house property, what are the deductions? So first thing is the municipal taxes, the taxes that you're paying on the property in question, right? So on that straightforward gets deducted. Then you also get a standard deduction of 30% on the annual value. after deducting the municipal taxes. What is the annual value? Is the fair rental value. So that's a little, a deeper calculation. Let's not get into that. Broadly, you need to understand what are the deductions available. So standard deduction at 30%, you can have on the net annual value. Interest on borrowed capital. If you have taken a home loan for the property, for the property in question, so you can have a 2 lakhs up to 2 lakhs. If it is for a construction purpose, you can have a 2 lakhs per year deduction on the interest that you have paid. 30,000 in case you have taken it for renovation purposes, repairs and renovation purposes. There you get a deduction of up to 30,000. Standard deduction of 30% of arrears of rent or unrealized rent. Now, what is unrealized rent? If if there's a default from the tenant, they have not paid rent to you over a period of time, so that is your unrealized rent. Now, after a certain period of time, suppose you get back the unrealized rent, then there also you can take a standard deduction of 30%. So that is about what are the deductions available from rental income. Against capital gains of house property. Now, what are capital gains? I have explained briefly. Like if you have a capital asset, you have purchased it at some point of time, and after a certain period of time, you have sold that asset. Then you have got the resale value. Typically, in house property, the costs go up, and we tend to make some gains. Those are called capital gains out of house property. If you're selling your house and you have made some gains, then what are the deductions that you can claim out of those gains? One is the brokerage and commission that you pay for the middleman that you hire for getting the buyer, searching for the buyer, so that you can take as a deduction. Any stamp papers, any legal documents that are required, so that you can take as a deduction. Traveling expenses with connection to these, transfer of assets. If it is in a different place and you have used flight and train services where you have, incurred a lot of expense to get that property sold, that becomes an expense which you can deduct from your gains. Now, if you have inherited a property, then the expenditure incurred with respect to procedures associated with the will and inheritance, succession certificate, the cost of the executor, all this will be allowed as a deduction if it is an inherited property. So these are the capital gains deduction. These are direct deductions that are available from the capital gains of house property. Now let's look at capital gains as in from shares, mutual funds, and debt mutual funds, and also how the calculations are done. So you should be aware of how these gains are calculated and when these gains will come into the picture. Okay, so first thing, let's look at shares and mutual funds. In shares, we have two categories. Shares and mutual funds, we have two categories. One is the equity linked and one is the debt linked. So in equity equity mutual funds and shares, these are the tax rates. I will come to the calculation on the next slide. If it's a short-term capital gains, now you should understand that the tenure of the holding of this asset decides whether it's a short-term or a long-term. So when is it called a short-term capital gain? In the case of house property, 2 years is the holding period. Is the holding period. So if you are selling the property within 2 years of purchase or construction, then that is a short-term capital gain. If you sell the property, house property, after 2 years, then it is a long-term capital gain. The calculation remains the same, what I'm going to show you now. In the case of shares and equity mutual funds, 1 year is the holding period. If you sell the shares and mutual funds just within 1 year of buying them, then you will incur short-term capital gains if you have made profits on that. If there is a loss, there is a provision to carry forward those losses. Now, in equity mutual funds, if you sell anything after 1 year, that's long term. Any gains or losses again will be taxed as per these days. In debt mutual funds, short-term capital gains come into picture if you're selling the debt mutual funds within 3 years. So in the debt category, 3 years is the holding period. After 3 years, it is categorized as long term. So now shares and equity funds, if you're making a short-term capital gain, if you have realized a gain within 1 year, then you have to pay 15% of the gains as tax plus cess and surcharge. If you have sold it after a year and if you have made profits more than gains more than 1 lakh in a year, then gains over 1 lakh are taxed at 10% plus cess plus surcharge. In the case of debt mutual funds, if it is a short-term capital gain, you are taxed as per your income tax slab rate. And over, after 3 years, if you're selling, you will get an indexation benefit. So here it is very important to understand that you get a benefit for the inflation that has happened over these 3 years or 7 years, whatever period you're holding it. Over these years, there would have been inflation in the country, in the economy, right? So what this inflation has done is it has reduced your purchasing power. So which also means that the same asset, if it was purchased today, its real or fair purchase price would have been much more. So the tax authorities give a benefit of indexation here to adjust your purchasing price for inflation, where your purchasing price goes up and your gains will reduce. So that's the beauty of debt mutual fund. You're given a very considerable inflation adjustment, and on after this, whatever gains are coming on that, 20% is charged and with cess and surcharge. So now let's look at how these are calculated. Short-term capital gains, they are calculated like this. So full value consideration is nothing but your selling price, selling value. Here you will deduct all the expenses incurred for these transfers. Less cost of acquisition. Cost of acquisition is nothing but your purchasing price and any cost of improvement. So this cost of improvement comes into the picture only for house property. In the case of shares and mutual funds, it doesn't come. So in the case of shares and mutual funds, it's only full value consideration minus cost of acquisition if it is short-term capital gains. If it is a property, you also get to reduce the expenses incurred for the transfer. Like I mentioned, the broker charges and transport, travel charges and things like that. You can get a deduction there. Cost of improvement, if in this period, if you have spent more money for the improvement, renovation, some repair work, that also you can have as a deduction. And then what are your gains will be calculated after that. Now, how are long-term capital gains calculated? Again, let's look at first one. Again, it's the same as short-term capital gains for the property. Now, I was talking about inflation adjustment in the case of debt mutual funds. So there, you get a indexed cost of acquisition. So same in the case of property also. After deducting the expenses related to the transfer or selling of the property, the cost of the property is adjusted for inflation. For example, you would have bought the property in the year 2005, let's say, and in 2023, you are selling the property. From 2005 to 2023, the same size of the property in the same locality, the cost would have gone up. So we are trying, after providing this indexation benefit, they will calculate the fair market value of the fair purchasing price of that property. So how is that done? So there is something called as cost inflation index. It's in simple terms, it's an index which adjusts the price. It's an index, like index in the sense a bucket of commodities are taken to arrive at the cost inflation adjusted. So there's a list of for all the years, all the cost inflation index numbers are provided. So for 2005, what is the cost inflation index? What is the cost inflation index for the selling year? Both have to be taken. So cost of acquisition, that is your purchase price, multiplied by CII of the year in which the asset is transferred, that is 2023, divided by CII of the year in which the property was sold, or 2005, or whichever year, relevant year. In case your property is purchased before 2001, then you have to take the base year as 2001, take the CII of that year, and then calculate indexed cost of acquisition. So that becomes your indexed cost of acquisition. So that goes here. So what happens is the purchase price goes up after this adjustment. So then your gains will come down. So same with indexed cost of improvement. In which year you have incurred that improvement cost, that you have to calculate after indexation and then adjust. So this is a brief of how long-term and short-term capital gains are calculated. So now let's see what are the tax saving options we can look at. So hope this is clear. So now we have understood how to categorize as a business income from your practice, or from your profession. How the consultant income can be looked at, where in which category it falls, when to take presumptive taxation and when to consider it as business income, what are the allowed expenses, how to compute your rental income, taxable rental income, capital gains if you have incurred, how to arrive at taxable capital gains. So all that we have seen. So after all these adjustments, then comes the applying of the Chapter 6A deductions. That is your tax saving options, whatever you have invested over the year. For tax saving purposes, that comes into the picture. The first one is your ATC. Everybody is familiar with ATC. So ATC has a maximum limit of 1.5 lakhs. So what all comes into it is your if you have a EPF, that comes into the consideration, your PF, equity linked saving schemes. There are some mutual funds which are tax saving mutual funds. If one invests in those, then you can have a ATC deduction of up to 1.5 lakh. Or your LIC premiums can be considered as ATC deductions. Your tuition fees of children, there's a limit to that. So, but that is also allowable as a ATC deduction. And the principal portion of the home loan that you pay, that also comes as a ATC deduction. But the overall limit for ATC is 1.5 lakhs. So usually this gets covered up with your PF and LIC premiums most of the times. So there's no much scope for principal coming into the consideration. But for people who have just started, who have not made these investments, so maybe they can consider. If their EPF is minimal, and if they are considering other options, then you can have a basket of these investments where you can save up to 1.5 lakhs. So after this comes the ATCCD. ATCCD is nothing but a new provision where NPS comes into the picture. Additionally, over and above the 1.5 lakh deduction, you can straight away get a deduction of 50,000 rupees here if you are investing in the National Pension Scheme. So that is one. ATD is Mediclaim benefits. If you are buying a health insurance health insurance policy for yourself, then you can claim 25,000, up to 25,000 of the premium as deduction. If you are buying it for your parents, health insurance policy, up to 50,000 rupees of premiums you can take as deductions. ATG is pertains to the donations, the recognized donations. If you make, as per the Income Tax Act, there are some categories of donations which are allowable as deduction. But there's also a limit of about 10% of gross total income you can make as donations and take a deduction for a tax deduction for the same. ATE pertains to interest paid on education loan. So if you have taken education loan for yourself or your child, and you are paying you decide to pay the installments for this, EMIs for it, you can take a deduction of the deduction on the interest paid on the education loans under Section 80E. Apart from that, there's Section 24B. That is, if you have a home loan, you can take you can get 2 lakh per year deduction for the interest that you're paying on the home loan. So these are the tax saving options one can maximum avail. Now, after all this, one would wonder which is the ITR form to be filed. This is very confusing so for most of us, right? So straightforward, let me put it in simple terms. If you are opting for presumptive income, that means if your total income is less than 50 lakhs and you go for presumptive taxation, it is ITR 4 for you. Now, who all fall in this category? Professionals like CAs, doctors, lawyers, engineers. Individuals who are drawing a salary as well as earning additional income from freelancing activities or part-time business, they also come under ITR 4 if their total income is less than 50 lakhs, of course. small business owners who do not maintain books of accounts, freelancers like bloggers, content writers, and individuals who make profit through F&Os, cryptocurrencies, commodities, and forex. Right. So all these can come under ITR 4. Who is eligible for ITR 3? Income from profession or business carried under proprietorship firm, and where your income is more than 50 lakhs, and you're going for a filing as a business income. Income earned from one or multiple house properties, then you're eligible to file under ITR 3. Rewards earned from winning a lottery or any other income, and income by way of assets in country outside of India. If you have any assets outside of India, and if you're earning any income from those assets, ITR 3 needs to be filed. Income generated from short or long-term capitals. If you have capital gains, considerable gains in any year, you need to file ITR 3. So that's all for today. If you let's go to the Q&A section.
Thank you, ma'am. I think we have one question in chat box.
Yeah.
Can I read it?
Yeah.
Yeah. So this question is from Mr. Bhabes. In which state, when one healthcare profession should register as a private limited company, what's benefit for individual and as private limited company for expense benefit and save income?
So this needs a little more elaboration, sir, actually. So we will get back to you over email.
Okay. The next question is,
Sanjay, 1 second before we proceed. Do we have Rachna ma'am? Rachna online?
Yes, she's there.
Yeah, okay. Yeah. So we also have our director, Mrs. Rachna Rego. So maybe if she can take, we can have some expert advice from her as well. Yeah, Sanjay, over to you.
Yeah, the next question is, what for professionals earning more than 50 lakhs?
So professionals earning more than 50 lakhs, you have to declare as income from PGBP, that is profits and gains from business and profession. You have to declare your incomes in that, and it comes under ITR 3 again. Yeah, Sanjay, any more questions we have?
Yeah, ma'am, we have one question in chat box. I'm not sure. Mr. Anirban wrote, what about HUF, Hindu Undivided Family?
So that is again very specific, so we need much more detailed understanding. Rachna ma'am, would you like to discuss that here, or should we revert on the email?
Yeah, actually, HUF is nowhere related to the doctors. It is a common thing where people can do it. But as an Hindus, you will have a karta, and I think so 2 years back they have changed the HUF law that even the daughter also can be karta. So you will be taking as a one of the. It's become an one entity. It's like a trust. So to save the tax, most of the people nowadays either they make the trust or they make the HUF to make sure that the Hindu divided family is being taken care of.
Thank you, ma'am. I think we have some questions in chat box. I will do it. So this question is that if I have got a consolidated salary of 3 months, out of which 1 month is March, that is 1st to 31st March, but the payout is done in month of May, then can I deduct the salary of March from my total gross income for current year?
If I
yeah, it's a correct question, but I'm assuming most of the time, as Varsha was explaining, whenever you are getting any income, so it can be a consulting income or a salary, the Form 16A will be telling. So nowadays, if you've noticed, a lot of government has started linked to your PAN and Aadhaar, and now AIS has come last year. So AIS itself is telling you, so whenever you are doing tax filing, the best way is to find it out what is your 26AS is telling. 26AS is the file which tells about the tax deducted at the source by any one of them. And AIS is talking about, which is an annual income statement, which talks about any of the sale or the income has happened. So logically, the March has to be declared and you must have filed the previous year and you can take this year's income. but it should match. So many times the notices comes because the person who is sending you 3 months and they have paid the TDS and other things on this financial year, there will be mismatch between you and the TAN number and the notice may come. So nowadays, to do and avoid these kind of notice, it's better to map it with your 26AS and AIS.
Thank you, ma'am. The next question is, what all expenses can be shown in tax and audit?
Yes, Mr. Ramakrishnan, we have explained it on the slide actually. So if it is business related expense, anything related to directly related to the running of your business or practice, that can be taken as a deduction shown in the tax and audit. So like salaries to nurses, your office boys, cleaners, which help in the day-to-day running of your business, your practice, clinic or nursing home. So those can be taken as a deduction. You must be using a car, so you can petrol expense, so cleaner expense, driver expense. So anything related to direct performance of your duties can be taken as a expense to show as in the tax pay.
Thank you, ma'am. First, I will read out the questions which we got in Q&A section. So, Mr. Mahesh K asked, how as a fresh dentist should plan for taxes, especially in a metro place like Delhi or Bengaluru, if he is employed is better than self-employed for tax saving?
1 second. So it's quite long, so I'm just trying to read. Okay, how as a fresh dentist should plan for taxes, especially in a metro places like Delhi or Bengaluru, if is employed, is better than self-employed for. Okay, if you're employed as a we have explained in the session. So if you're employed as a consultant, then it comes as a profits and gains from business or profession. If you are paid salary as a full-time employee of a hospital, then it comes under income from salary. So if you're self-employed or you're planning to set up your dental clinic, then that becomes as a business. So again, if your income is not more than 50 lakhs, total income, like income from this dental clinic and things like that. So all put together, if it is not coming more than 50 lakhs, we suggest you go for presumptive taxation because that is beneficial. There, what happens straight away, 50% you can say that 50% are my expenses out of all the incomes, and 50% is my profit. And on that 50% you can pay tax. So I had also shared the illustration on the slide. We will share the slides also with you after the presentation, and after a few days the recording of this video will also be available, so you can go through once again. If you have any more queries, any specific queries, you can always write to us and we will respond. I hope that answers.
To just add, Varsha, one more line as a simpler way is whenever you are salaried, you cannot do anything other than the deductions. So deduction is only ATC, your ATD, ATE means medical insurance. You have any of the taking care of, you have done charitable anything, you have an interest on the house loan. These are the deductions available. Expenses are not considered. But when you are professionals, expenses are considered. So you have to just think of very common thing. Even if I'm professional, I am a consultant, I am under business, which is ITR 3. And if I am salaried, I am ITR 1 or 2, which is only deduction sections are available. So it is always a better to have the, I can say consulting, but let me give you the disclaimer because I have been going to many hospitals. Whenever you are young and doing freelancing or the professional income, you are getting a loan and CIBIL scores are low. So what most of the young people does it, they normally take a salary for first few years. In case of your loans, it's much easier because getting a consulting income, the normally if you are a salary, they may give you the loan till 70 to 80%. But if you are in consulting, the banker normally give you 40 to 50%. So that's a one more reason when you are young, you may try to take it as a salary because it's not much of the difference. I was looking somewhere, people have asked what is a regime one or it's called old or new mostly. So regime 1 and 2 is depending on your what are the deductions you are available. So if you are taking an deduction, especially without fail home loans, don't think of a new, please go ahead with the old because that's the most beneficial. But if you are young and you are just doing a normal deduction of ATC and other things, you're till 15 lakhs, you will be a better off on a new regime. Make again one more condition, think of a long term because these are the rebated given by the government. We don't know how long this will go. So it's better to take all the deductions what is available because government allow only once. Please remember only once to move from new regime to old and old to new. You cannot keep moving between old and new regime on tax filing. Yeah, go ahead, Sanjay.
Yeah, thank you, ma'am. Varsha ma'am will be taking the question. Meantime,
Yeah,
I will
please.
run two quick polls.
So there's one more question.
Yeah, ma'am, you can take the question.
Yeah, when is audit mandatory before filing the returns for proprietorship income? So, like we said, if the annual turnover is more than 50 lakhs, then audit is mandatory. For if you're registered as a proprietor for the clinic or nursing home.
So to add here, any business income above 50 lakhs is audited income.
Yeah.
So you cannot file your own, you need an auditor to audit it.
Yeah.
Yeah, I think so. Two people are raised hand. Sanjay, can you allow them to ask a question? And
Sure, sure. Yeah, Mr.
yes,
Manohar.
yes. Good evening, Manohar. Please unmute and you can ask a question. Can you unmute Sanjay to him? He may be not able to unmute. You can ask another person who has raised the hand.
Only Mr. Manohar only. I think he is okay. Yeah, Mr. Vipul, you can.
I would like to ask if the income goes about 20 lakhs, then GST will be applicable for doctors, or there is some provision where GST is not applicable?
Again, GST is to the some professional where doctors are sometimes is not like a lawyer and doctors are not allowed, but depending on you are on a consulting or you have your own business. So it depends on like is for example, I'm just giving example like most of the doctors has combined together and taken as a partner and the entity is different, the GST is applicable.
Okay, so if there is a doctor who's doing a dentist thing and he's doing he has his own consulting business, in that case,
It's not.
uh, GST is not applicable. So what is the law, or where can I read more on this, ma'am?
So most of the time CA will tell you, but if you can write a mail, we will be able to connect and tell you the actual clause and the law.
Okay, okay. Please send us the email ID on the question and answer tab. Thank you so much, Rachna ma'am. Varsha ma'am, excellent presentation.
Thank you, Mr. Vipul.
Thank
Mr.
you.
Vipul, to add to Rachna ma'am, you can also visit income tax website. There most of the information is available. Of course, it will be a lot to read, but I think you can run through once if that makes sense.
Right.
Otherwise, you can write to us and we will also reply to that.
Thank you.
Any more participants want to ask a question here? You can raise your hand and we'll unmute and you can speak.
Mr. Manohar, would you like to try now?
Mr. Manoharan, if you're there online and if you want to try unmuting, you can try.
I think so, Sanjay, there's a question from Vinod Singh Wist. Actually, you can just do the calculation offline and send the calculation. But I'm assuming you are claiming all the deductions, so you are under old regime. So in the 12 lakhs, if you are taking care of ATC and NPS with the medical claim, you should be very, very less. But yes, to give it a precise answer, we will give you the exact with the calculator.